Hi, this is Mike Maloney with the Gold Report for June 23rd, 2016. And people will often ask me, if I'm a precious metals dealer, why will I sometimes say that I think that gold and silver are going to go down? Over the long haul, I believe that they are going up. But in the short run, there's all of these little wiggles, and the wiggles really don't mean that much to me. But I find it very disingenuous for any dealer that is selling precious metals to just try and sell them by saying that gold is always going up. Everything runs in waves and cycles, and there's bumps and dips along the way. Do I think that gold and silver are going up and down in the short term? Well, we'll get to that in a minute, but basically I don't care. Do I think that they're going up or down in the long term? I think they are going up absolutely without a question. The one guarantee that you have in life is that central banks will always print more currency. So when everything is measured in that currency, if you continuously expand these currency supplies, eventually prices rise, especially the price of real money. Another thing that I am asked is, I tell people that I believe that there is a short-term deflation coming, that it almost has to happen. And with that deflation, I expect the price of gold and silver to take a temporary dip down. And so people will say, well, if I think that it's going to go down, shouldn't I wait and buy my gold and silver then? Isn't that a better plan? And to them, I say, certainly, that is a better plan if you're going to buy futures contracts, SLV or GLD. If you want to buy real gold and silver, it may not be such a good plan. Real gold and silver may take a dip along with the futures contracts, but if it's like 2008, a lot of the products are going to go into shortage, and you won't be able to buy them. You may end up paying far more than you would have had you just bought them beforehand when they were available. So let's get into the analysis now. This is the Commitment of Traders report. And the reason I show this is because of their history. The commercials have a history of being right. So usually if you're on the same side that the commercials are, you're probably going to win. Someday that will not be the case, though. But I do want to point out this middle chart here, the top chart is the price of gold. The middle chart is the position, the net position. If you take the commercials, the big traders, and you take the longs from the shorts, and you end up with a net, and the net here is minus 298. And then the non-commercials and the non-reportables, you add those together and you come up with the same figure as the commercials, but they are on the positive side. So it's plus 298 between these. So it makes this mirror image graph. But the commercials are the blue ones at the bottom here that are betting most of the time that precious metals are going to go down. Now there is a reason that I'm not going to get into right now why they are always net short. But what you should notice here is that when their positions reach an extreme and you take a look at the price, from the time that their position is at an extreme to the time they minimize their exposure and reduce their number of contracts, there's usually a corresponding price dip, and so they are winning because they are short the metals. And you see this time after time here where they are the winners catching all of these little dips just over and over again. They win when the price falls, when they are short. So I'm looking at the blue section of this graph down here compared to the price over the same period of time. Look at this peak here and that dip, and the commercials caught all of that price action and they won. And this happens time after time. And if you look at where we are today, this exploded up to a huge level of short position here, and the price fell, and a few of them covered, but not that many. With all the covering that they did from their maximum bet to this little dip right here, that's still a bigger position than we've had over the past year here. But what you see again is that this has exploded to an extreme once again. and the price is high once again. It's had a run-up, and with that run-up, they've placed more and more bets saying that the price is going to go down. So this is just the price of gold with the 50 and the 200-day moving average on top of it, and I've explained the moving averages many times, so I won't go into that right now. But let's just do a couple of little what-if scenarios. You'll notice that we've had a couple of ups and downs here, and this last one, it went up and peaked and then did a small pullback, a little rise, and a very large pullback, and it took a little bit more than a month to complete that. Well, what if the same thing happened here? What if it did a pullback and a little rise and a further pullback? You'll notice that the red line is the 200-day moving average. And I've been saying that gold has to go and revisit its 200-day moving average sometime. Now, the alignment of these moving averages, the 50-day being above the 200-day, is a very bullish thing. This is a positive thing for gold. This is actually a fair amount to drop to go all the way back to the 200-day moving average. But if it plays out over about a month period and the 200-day moving average rises, what happens? Well, you could get something that looks a little bit like this, and I call this a triple magnet. We have something called round number support at 1200. We have a trend line in the same area, and we have the 200-day moving average. I've extended it here, but it's rising, and they could all meet in about a month, and that would be like a triple magnet attracting the price there. I do believe that the price has to go revisit the 200-day moving average sometime. Now is as good a time as any. But is that going to happen? I have no idea. Technical analysis is only right a little bit more than half the time. Do I sell my position and bet that gold is going to go down and then rebuy down there? Well, if you're right every time, that's a good plan, except you're increasing your tax exposure, and you're also increasing the risk that when gold does make its big moves up, that you're not going to be in the game at that point. So I accumulate, I buy, I do not sell, and I buy when the price is up and I buy when the price is down. It's called dollar cost averaging. And here's the reason that I really don't care about this little price dip. I like to pay attention to the big picture. The big picture is what's important to me. I am not a get-rich-quick guy. I'm a get-rich-slow guy. You can count on it a little bit more. But what you're talking about is paying attention to these little tiny wiggles in here. I couldn't care less. I started accumulating back in here in October of 2002. That's when I started buying gold, and this is when I started buying silver in 2003. And I've been accumulating the whole time, and I did buy some up in this range. I didn't buy silver. This is the price of gold. Silver was peaking back here in April of 2011. I wasn't buying any silver right then. I was only buying gold. I started buying silver again right after silver took its big drop off of 48 bucks. But these little wiggles I don't care about. In deflation, there's very strong support in the 1,000 area here, and so it could take us down there. It could take us even down into this range if we have a severe enough deflation. Am I going to just sell my position and wait and hold out until it goes down there? I have no idea if it's going down there. So no, I'm not going to do that. Second, like I said earlier, in this dip in 2008 here, I was a dealer. There was a period of time where we had no silver to sell anybody. It was just gone. And when we did, we were paying a huge premium for it, and we were charging a huge premium for it because we knew that we were going to be out of it by the end of the day. But there was a month where we couldn't get any silver except for 1,000-ounce COMEX bars, and there was a week where we couldn't get any gold except for kilo bars of gold. So you're talking about $30,000 or more, a minimum investment for gold. And then there was 3 days where we had no products whatsoever to sell during that period of time. And so the prices on physical went way up. Instead of taking this dip, they started to go down, and then the prices on physical actually started to rise. And so this is futures contracts. You could buy those down here. You could buy GLD and you could buy SLV. But real gold and silver, no, it didn't go along for that dip. If price falls down to $700 here from almost $1,300 right now, during a deflation, and this would take time to play out if it did, but I would expect that the gold and silver will become unaffordium and unobtainium, and you just won't be able to get any real stuff. You'll be able to expose yourself to the paper contracts, and that's about it. So I don't care about these little wiggles. My plan has always been to accumulate and accumulate over time. And what I do is I measure it against this. This is the Dow Gold Ratio. I've shown it many times. So you take the points on the Dow and you divide it by the price of gold each day, and it gives you how many ounces of gold. This is the number of ounces of gold that one share of the Dow is worth. And what you see is it runs in a wave and cycle here, and we're just part of the way through a cycle. When you look at this graph, you're looking at the value of stocks measured with gold. So when you're looking for the performance of gold, this graph is actually inverted. Gold is gaining in purchasing power when this line is falling, and it's losing purchasing power when the line is rising. But what you notice here is that from 1966 to 1980, that was the big bull market. Actually, it started in 1971, but the Dow Gold Ratio starts in 1966. But the big gold bull market started 71 to 80. And what you see is that there's this big jag in the middle of it where there was a bear market in gold. From the first day of 1975 through September of 76, gold fell by almost 50%. Then it resumed its bull market and went down. I'll show you a graph of this inverted later so you can see the performance of gold. But what I want to point out here is that I've been saying for a long time that this bear market that we've been experiencing for the past 4.5 years or so in gold and silver is just a repeat of this 1974 bear market that happened. It's a cyclical bear inside of a secular bull. And I've been expecting this, and I've been saying that it would happen, and the crisis of 2008 was not the pullback that I'm talking about. It was something very small by comparison. So we are in this pullback, and I think that it may be nearing its end, because from this peak here, where the one share of the Dow cost 28 ounces of gold, down to this dip at the last day of 1974, that is a fall of 88%. And coincidentally, this graph here, this is actually 45 ounces of gold was the extreme. But this fall from the 45 ounces of gold down to 6 here was 87%. So you've got 87%, 88%. They're almost identical in the amount of their fall. And then this bounce that it took here, this is a 170% rise. This is a 180% rise. So those are almost identical. So it could be that this pullback that we have been in for almost 5 years now is nearing its end. And the way that it mirror images the 1970s bull market, except it's very stretched out over time. And because it's very stretched out over time, to me that suggests that it's also going to be stretched out in magnitude, that it's going to be a much larger bull market than before. And I promised you that I would flip this so you could see it. When the line is going up, gold is rising and the Dow is falling in value in relationship to each other. And so what you see here is it rises and makes this peak and then pulls back, and then it's off to its major bubble peak that it was at in 1980. And then we have the most undervalued in all of history that gold was, and then it rose up to not even what I consider fair value, this range in here where it's spent an awful lot of time. We never reached fair value for gold. It's pulled back, and it looks like we may have seen the bottom of that, and it's going up. So in the very short term, I think gold could take another dip. I don't really care. I buy anyway. I think that there's going to come a day where a bunch of the people that try and trade in and out, where they're going to become big losers. But in the long run, this is what I'm looking at. Dow Gold Ratio, Gold Real Estate Ratio, and a whole bunch of other ratio charts to tell me whether I think that gold and silver are done with their bull market, and they are nowhere near being done with their bull market. This time, it isn't just a bull market in precious metals, it's a bear market in currencies. Thank you very much. If you got anything from this video, please like it and share it, and we'll see you next time.